Inflation is an economic concept that refers to the general increase in the price level of goods and services in an economy over a period of time. In other words, it represents the decline in the purchasing power of a currency, as each unit of currency buys fewer goods and services. Several factors contribute to inflation, and economists often categorize them into demand-pull inflation, cost-push inflation, and built-in inflation. Welcome back to another exciting video. Today's video is about what is inflation, economics explained. Before we start the video, please like, subscribe, and press the bell icon. Demand-pull inflation. This occurs when the overall demand for goods and services exceeds the available supply. When demand outpaces supply, businesses may respond by raising prices, leading to inflation. Factors such as increased consumer spending, government expenditures, or investment can contribute to demand-pull inflation. Cost-push inflation. This type of inflation is driven by an increase in the production costs of goods and services. Factors like rising wages, higher raw material prices, or increased energy costs can lead to higher production costs. To maintain their profit margins, businesses may pass these increased costs on to consumers in the form of higher prices. Built-in inflation. Also known as wage price inflation, built-in inflation occurs when workers demand higher wages, and businesses then raise prices to cover the increased labor costs. This creates a cycle where higher wages lead to higher prices, and vice versa. Measuring inflation. The Consumer Price Index, CPI, includes a basket of goods and services that represents typical consumption patterns. This basket includes items such as food, housing, transportation, and healthcare. By tracking changes in the prices of these items over time, economists can quantify the rate of inflation. The Producer Price Index, PPI, on the other hand, measures the average change in selling prices received by producers for their goods and services. Inflation is commonly measured using price indices, which track the changes in the prices of a basket of goods and services over time. The Consumer Price Index, CPI, is a widely used measure that reflects the average price change paid by consumers for goods and services, while the Producer Price Index, PPI, measures the average change over time in the selling prices received by producers. Effects on purchasing power. Inflation reduces the real purchasing power of money. For example, if inflation is 3%, a $100 bill would have the same nominal value, but its real value in terms of goods and services would decrease to $97. Consumers may need more money to purchase the same basket of goods over time, impacting their ability to maintain a certain standard of living. Inflation erodes the purchasing power of money. As prices rise, each unit of currency buys fewer goods and services. This can impact individuals on fixed incomes as their purchasing power diminishes, and they may be able to afford fewer goods and services than before. Hyperinflation. Hyperinflation is an extremely rapid and typically uncontrollable increase in prices. It often results from a collapse in the confidence of a country's currency. During hyperinflation, people may resort to using alternative forms of currency or bartering for goods and services. Governments may struggle to stabilize the economy, and the social and economic consequences can be severe, including widespread unemployment and social unrest. Hyperinflation is an extreme form of inflation, where prices skyrocket at an exceptionally high rate. This can lead to a loss of confidence in the currency and cause severe economic instability. Historical examples of hyperinflation include the Weimar Republic in Germany in the 1920s and more recent cases like Zimbabwe in the late 2000s. Deflation. Deflation, or a sustained decrease in the general price level, can lead to economic challenges. Falling prices may seem beneficial for consumers at first glance, but if prices continue to drop, individuals and businesses may delay spending, anticipating even lower prices in the future. This can result in decreased demand, lower production, and rising unemployment. Central banks often aim to maintain a low positive inflation rate to avoid the negative effects of deflation. While inflation is the general increase in prices, deflation is the opposite, a general decrease in prices. Deflation can be problematic for an economy as consumers may delay spending in anticipation of lower prices in the future, leading to a decrease in demand. Central banks also aim to avoid deflation and often target a low, positive inflation rate to promote economic stability. Role of central banks. Central banks use various monetary policy tools to influence inflation. One common tool is adjusting the benchmark interest rate. If inflation is too high, a central bank might raise interest rates to cool down the economy and reduce spending. Conversely, if inflation is too low or the economy is in a recession, a central bank might lower interest rates to stimulate borrowing and spending. Central banks play a crucial role in managing inflation through monetary policy. By adjusting interest rates, controlling the money supply, and implementing other tools, central banks aim to achieve their inflation targets. For example, a central bank might raise interest rates to cool off an overheated economy and reduce inflation or lower rates to stimulate economic activity during periods of low inflation or deflation. Inflation expectations. Expectations about future inflation can influence economic decisions. If people expect prices to rise, they may adjust their behavior accordingly. For instance, workers might negotiate higher wages, and businesses may factor in expected inflation when setting prices. Central banks aim to anchor inflation expectations to their target rate, as stable expectations can contribute to economic stability. If people believe that inflation will remain low and predictable, it can reduce uncertainty and promote sound economic decision-making. Central banks often communicate their inflation targets and policy intentions to help shape these expectations. Expectations about future inflation can influence current economic behavior. If people expect prices to rise, they may adjust their behavior by spending more or investing in assets that can act as hedges against inflation. Central banks often consider managing inflation expectations as part of their overall strategy to maintain price stability and anchor long-term inflation rates within a targeted range. Inflation is typically measured using various price indices, such as the Consumer Price Index, CPI, or the Producer Price Index, PPI. Central banks and policymakers often aim to manage inflation, with a target range considered healthy for economic stability. Moderate inflation can encourage spending and investment, but high or hyperinflation can have detrimental effects on an economy, such as eroding savings, disrupting business planning, and creating uncertainty in financial markets. Central banks, like the Federal Reserve in the United States or the European Central Bank in the Eurozone, use monetary policy tools such as interest rates to try to control inflation and maintain price stability in the long term. Thank you for joining us on this exploration of passion and connection. If you found these tips helpful, be sure to like, subscribe, and share. We'll be back with more insights and inspiration to keep the flames of love burning bright. Until next time, keep the spice alive and the love thriving.